What do you think happens when the Federal Reserve itself collapses? What happens to the dollar? Well, the issuing bank of the US dollar is the Federal Reserve. So when it crashes, the dollar crashes too. It's just basic logic, people. Well, hello there, my friends. Rafi here from the Endgame Investor with this week's Silver Report for Arcadia Economics. And this week, I'm not even going to do a PowerPoint presentation because I got a whole bunch of tabs of interesting and fascinating little snippets that I'm just going to go from tab to tab instead of from PowerPoint slide to PowerPoint slide. And I know that comes hard on some of you, and some of you have been commenting on the plethora of paintings behind me. Well, my two oldest daughters take this art class, and so does my son. And they keep coming home with more and more paintings, and I don't know what to do with them. And I can't even see half the colors, but whatever. And so I just keep stacking them up behind me, and I'm soon going to be drowned in a bunch of paintings. I don't know what to do. But anyway, we're going to go back to the 1980s, into the savings and loan crisis. We're going to do like a game. I'm going to read something from the 1980s, and you're going to tell me, I'm going to read something about a bailout, and you're going to tell me what year it was from. Well, you're not going to be able to tell me because they're all the same thing, and they keep happening over and over and over again. We're going to go into deposits in the banking system, which are collapsing both in large banks and small banks. Money supply is falling. We're going to talk about China and Brazil, or whatever these BRIC countries are, trying to get around the dollar. I am excited about this. This is good news. However, let's not read too much into it, because by using the Yuan for trade settlement does not necessarily mean they are getting around the dollar. They are using infrastructure to eventually get around the dollar, but it's not exactly getting around the dollar yet. We're going to talk about fake Fed stress tests, where they tested everything except for rising interest rates. And why would they not test for rising interest rates? Because they knew they were going to do it, and they didn't want to test for something that they knew that the banks would fail, because that would cause a banking panic, which is happening now. But anyway, let's get going with this week's Silver Report. We're going to stuff this with some memes, but first of all, let's go to our sponsor, Fortuna Silver Mines, symbol FSM. I want to show you this chart of FSM relative to the silver price. If you want to get a good price on this stock, we can see here that we are very close to the historic lows in FSM relative to the silver price. We hit, what was it? It looked like a 10-year or 13-year, something like that, 14-year low back in September 22 when silver hit a low here. And we are headed back up. We're just on the 50-week moving average of this metric of silver relative to the price of Fortuna Silver Mines. So that means that Fortuna Silver Mines is priced relatively low relative to the metal that it mines out of the ground. And historically, we have been above this line, about 0.157, for most of FSM's history. So are the chances that this price will go up relative to silver high? Indeed, they are by historical standards. And because I believe that most silver and gold miners will become banks in the end game, where they will loan out their gold and silver on interest, because there will be no other money with which to make loans, then these companies, including Fortuna, including all gold and silver mines that are responsibly managed, will become the central banks of the not too distant future. Anyway, let's get on with this week's Silver Report. First thing we're going to do today is go into deposits for small domestically chartered commercial banks. Those are the banks that are in major trouble, the small regional banks that are losing deposits. Now let's look at this historical chart of deposit changes, percent change from a year ago. So we see that right now we are below zero. So they have been losing deposits from a year ago at about a rate of 1.39444%. That's not 1.39445. Get the number right, 1.39444. Very important there, of the fifth digit from the decimal. But anyway, I am facetious, and let's go back to this era over here. You remember 1985, 1986, blah, blah, blah. What was happening then? Besides Back to the Future, it was the savings and loan crisis of the 1980s reaching a climax. So deposits were fleeing small domestically chartered banks because the savings and loan banks were collapsing. And what was the regulatory regime back in the 1980s, and how did they fix it? Well, let's read a passage that sounds very, very familiar. This is from Investopedia. It's like an encyclopedia of investment. It's like a genius name. So it says here, savings and loan crisis, resolution. It was resolved. Everything's fine now. None of the problems from back then have been carried over to the present. That's just propaganda and misinformation. But anyway, as a result, it says here, of the SNL crisis, Congress passed the Financial Institutions Reform, Recovery, and Enforcement Act of 1989, FREA. That's like a great acronym, FREA. It makes me feel really warm and gooey about the banking system, which amounted to a vast revamp of SNL industry regulations. One of the most significant actions of the FREA was the creation of the Resolution Trust Corporation, which had the goal of winding down the failed SNLs that regulators taking control of. Well, isn't that, well, see, they re-regulate the banks, they revamp everything, they create another Resolution Trust Corporation or financial stability mechanism or whatever the hell they're creating, and they say everything's fine now. Important. Here's a lightning important fact. Listen to this. FREA was passed by George Herbert Walker Bush and provided $50 billion to cover costs and losses associated with the crisis. $50 billion. $50 billion. What is it with this number that keeps repeating decade after decade?
Over the weekend, despite soothing words and a 50 billion Swiss franc line of credit from the Swiss Central Bank, it was clear it was not enough to save the bank.
Thousands of investors who may have lost up to $50 billion, according to Madoff himself.
Oh, God! 50! 50! Yeah, 50! Woo!
Not to 50!
This sounds familiar too. The act also put forth minimum capital requirements, raised insurance premiums, limited SNL non-mortgage and mortgage-related holdings to 30%. 30%. Limited SNL non-mortgage and mortgage-related holdings to 30%. Let's examine something, okay? So the 1980s SNL crisis, when small banks were losing deposits hand over fist, regulators decided to cap mortgage-related exposure to 30% of a bank's balance sheet. Well, let's look at something for a second. It's called the Fed's balance sheet. This is assets, securities held outright, mortgage-backed securities when available. This is the Federal Reserve's balance sheet, the issuing bank of the US dollar. And so we have here the amount of mortgage-backed securities on the Fed's balance sheet as of March 23rd, 2023. That number is $2,605,235,000,000. $2.6 trillion. Now let's look at the entire balance sheet of the Fed, and that number is $8,733,787,000,000. And what is 2.6 trillion out of 8.7 trillion? That is precisely 30%. So the Federal Reserve is at the limit of what was imposed in the 1980s for other savings and loan banks who held mortgage-backed securities and collapsed because they held too much. What do you think happens when the Federal Reserve itself collapses? What happens to the dollar? Well, the issuing bank of the US dollar is the Federal Reserve. So when it crashes, the dollar crashes too. It's just basic logic, people. This has made big news and is making the rounds in the gold and silver circles. But I want to try to interpret this a little bit more soberly. Not that I'm not excited about this. I am. I just want to manage expectations here through Austrian school logic. Okay, so the title says, China settled its first LNG trade in Yuan, but gold remains the bigger winner in the global de-dollarization trend. Okay, fine. I agree with this headline here. Let's read the first three paragraphs. The U.S. dollar's role as the world's reserve currency continues to be tested as nations settle commodity trades with the Chinese renminbi. Tuesday, the Shanghai Petroleum Natural Gas Exchange announced that it completed its first yuan-settled trade for liquid natural gas between China's National Offshore Oil Corporation and France's Total Energies. Okay, that's pretty much all we have to know about this deal. So there's a whole bunch of natural gas being traded between France and China for Chinese yuan instead of U.S. dollars. Now, it's exciting, okay? It does relegate the dollar more to the back door. However, does it really get away from the dollar? Not really, because the dollar, remember Exter's pyramid. You have gold and silver arguably below gold, but let's just say gold and silver, and then the US dollar, and then other currencies that are derivatives of the US dollar, which includes euros and yuan. Why is the yuan a derivative of the US dollar? Because the main driver of the yuan is its trade relationship with the United States, which is most of its exports. And so the People's Bank of China keeps the yuan within certain windows. And so the People's Bank of China's monetary policy more or less follows the Fed and tries to keep the yuan within exchange rate windows. So basically, the yuan is still the US dollar, even if it's using the yuan instead of the US dollar. If the yuan strengthens too much relative to the US dollar, then the People's Bank of China have to weaken the yuan in order to keep that exchange rate within certain windows. In order to get away from US dollar dominance, you have to go beneath the dollar in the pyramid. You can't go above it. Remember, the dollar and above the dollar is derivatives of the US dollar, which includes the yuan. And so in order to get rid of the dollar and to get out of the dollar trading regime, you have to go beneath it. You got to go to gold and silver. Once nations start trading gold and silver, then they are really, in a bona fide way, getting out of the dollar system. But trading in yuan, it's a good scaffolding. It's a good exercise in getting away from dollar dependence. But is it getting away from dollar dependence? Not exactly. Now let's go through this pretty hilarious article from Bloomberg about bank stress tests. Says Bloomberg here, Fed's bank stress tests, it means, overlooked risk of rapid rise in interest rates. Well, you would think that an institution that does nothing but tinker with interest rates would have tested its member banks for their ability to withstand rising interest rates, but no.
Everybody knows you never go full retard. You went full retard, man. Never go full retard.
That's not what happened here. Why? Because bank stress tests are just misinformation, actually, and they are meant to lull people to sleep, to try to make people believe that the banking system is more stable than it is by not testing for the actual stressful scenarios. It's understandable. You can't have the Fed admitting to everyone that its bank failed the stress tests, and then what would people do the next day? They would take their money out of banks, which is exactly what they're doing now. Let's skip this entire article and go to just the table here that Bloomberg cites with its amazing research, and says, if you look at this column here, they're testing this severely adverse that the banks would not be expected to be able to get through. In every single one of these severely adverse scenarios, rates either fall or remain near zero. And what's happening now? Well, rates are not falling, nor are they remaining near zero. They're actually rising. But did the Fed actually try to test these scenarios in any of its severely adverse scenarios? No. It's all safe and effective, people. The banking system, safe and effective. And the last point I want to make here is that the housing market is involved in every banking crash since the 1930s and probably even before. This time, the housing market is intimately tied with the US dollar itself, because the biggest bulk of assets now backing bank deposits are mortgage-backed securities, because it used to be treasuries, but now that has been bailed out by the Fed offering face value on all treasuries purchased before March 2023 so they can get those losses off of their books. What remains is mortgage-backed securities. Now, who owns these mortgage-backed securities, and how much, to what degree do they back existing deposits in the banking system? So here we have that table, which appears on page 37, the very last page of a recent New York Fed research article, as to the percentage breakdown of who owns mortgage-backed securities and to what degree.
Give me the page.
What are you talking about? It's got to be a typo.
Give me the goddamn page.
Okay.
So here's that page from the New York Fed. This is the breakdown of some New York Fed research paper written last year. Table A.1. Who owns this stuff? So first of all, the biggest tranche of mortgage-backed securities owned is by depository institution, aka banks. They own 32% of all mortgage-backed securities. But after that, you have the Federal Reserve, 23% of all mortgage-backed securities ever issued that are still extant. And so what do you think happens when the housing market falls this time? When the housing market buckles this time, you have two institutions that get their assets written down. That is commercial banks and the Federal Reserve. So you have both a banking crisis and a dollar crisis. When the Federal Reserve has its assets written down, that is a dollar crisis itself because its assets are the things that back the US dollar itself. When you have a banking crisis and a dollar crisis at the same time, that is when people panic into real money, into gold for the banks and silver for the public. It's going to be hard for us to fathom how fast this panic is going to be. It's going to be very fast, and people who chase it are not going to be able to acquire a lot of stuff in terms of gold and silver ounces. But those who have already stacked should be fine. I have the feeling that the last fulcrum of the support of the current monetary system is the housing market itself. And when it buckles, everything buckles with it except the base of the pyramid, which is gold and silver. And after that, human civilization can rebuild another one of Exeter's pyramids, and it should be fun and an educational experience for our children and grandchildren to enjoy. This is Rafi of the Endgame Investor coming at you with this week's Silver Report for Arcadia Economics. If you enjoyed this video, then consider signing up for a 2-week free trial of the Endgame Investor or become my patron on Patreon, where you get a weekly video of biblical commentary about economic policy and monetary policy and government from a society that existed about 2,000 to 3,500 years ago. And that's always fun. See you guys next week.